great to have you back. How are you feeling?
Oh, well, I mean, I've been better in some ways. I think it's just a little, I think, disappointing to see a little bit of the retracement in the ADR space. And, certainly it's been a poor week for global equities, but maybe a little bit more of an emphasis on the China side and even in broader Asia. Europe held up a little bit better, but for China, it was definitely a week to forget.
Yeah, sure. And we're almost back to the levels when Liu He kind of saved the markets, right? I think it's like minus 10% this week for KWEB. Last week, we talked about very optimistic about stimulus coming, right? And, something that sets apart China, but it seems like the market didn't seem that or maybe expected more.
Yeah, I think more the latter, maybe expected more where, on last Friday, there was the anticipation for the bank reserve requirement ratio to be cut 50 basis points, and it was cut 25. And then neither the loan prime rate nor the medium-term loan facility rates were cut. So I think, the PBOC did come out and say, well, we didn't do these explicit monetary easing. At the same time, they transferred a very significant amount of money from profits that they had generated to the government, and that was returned via tax returns that they provided a large amount of VAT tax returns. So they're providing a level of easing, just not necessarily. It's a little bit different. And then I think it's clear they're going to take a more kind of incremental process toward easing, as opposed to pulling the proverbial Band-Aid, or as some people say, pulling out the bazooka. So it's I think there's a little bit of that adjustment, but I would agree that the markets was expecting more and was left a little wanting. And then you've got our kind of backdrop of this Shanghai lockdown situation, this kind of global value growth rotation, higher U.S. interest rates, and those are certainly factors in the broader kind of very negative sentiment at this juncture for the space.
I just saw the news that China is about to introduce a private pension system, right? And actually, we also had a call by the CSRC telling institutions, or it was a meeting to kind of load up on equities or at least get more exposure. And I think that's the right step, actually, right after having lots of savings actually tied up in home ownership. And so that's the right next step. So it's kind of really, interesting how this story unfolds, right? Because it's now also a very interesting time to invest in it. And I think in your China Last Night, you also wrote about that we actually see net buying from the mainland side, right?
Yeah. Certainly, the CSRC put out a statement saying that, they're speaking weekly with the U.S. regulatory bodies on solving the Holding Foreign Companies Accountable Act, as well as they held a symposium that included the National Social Security Fund, insurance companies, and bigger banks, about them increasing their equity percentage for a lot of their long-term investments. And so they're clearly focused on bringing some capital in to help stabilize the market. So I think those will play out. We'll see, hopefully see that play out. But certainly on the Holding Foreign Companies Accountable Act, I think just we've heard this from the China side several times. So there's a little skepticism. People want proof; they want tangible results, as opposed to some of this talk. So that's where we've kind of described it as a crisis of confidence, that people want to see real action. At the same time, we are seeing via Southbound Stock Connect, that following the Thursday sell-off, of the U.S. ADRs, investors were net buyers of say, in particular, Tencent and Meituan overnight. So, so people were, an element of investors were using this as a buy the dip opportunity.
Yeah. And also I read today, like JD.com is also starting issuing a dividend, right? For maybe also helping investor confidence here. I think it's like half of their market cap is currently the cash position as well, like with many other Chinese names. It's a unique situation, right? They have like, it's both value and growth at the same time. Those, at least like the bigger names like Alibaba, Jingdong, Baidu. It's quite interesting.
Yeah. Alibaba has become the biggest position in MSCI emerging markets value. And I think that the JD dividend is interesting because, one element we're seeing, this, proverbial crisis of confidence is a little bit of a buyer's strike. So, midweek, a significant global investment bank, put data showing that actively managed EM funds are very underweight, particularly Alibaba and Tencent relative to the index, about half of the weight. And the general China internet space is underweight relative to the index. But so you have a little bit of this buyer strike. Now, one thing I've been starting to track a little bit more often is the Hong Kong short selling volume. So while aggregate volumes were light this week, the short selling volume was actually above average. So you have, a lot of buyers are sitting on the sidelines, but you have this downward pressure from the short selling. That makes JD's dividend kind of interesting because when a stock pays a dividend, if you're short the stock, you owe, as the short seller, you owe that cash back. So JD, is, they likely are communicating to say, hey, look at how much cash we have, how cheap the stock is, we're going to be shareholder friendly, pay out the cash. Again, another read is that, by using cash, they're showing that they're comfortable with the China regulatory cycle, but they're also doing something interesting is they're hurting the shorts.
Very interesting. Yeah.
That the short sellers are going to owe the amount of the JD dividend. And so that cost of having a short position in JD just got a little more expensive.
And it's actually also taking away one more argument that, like, more from the short side, which is like, well, the Chinese companies, they only go there to list and then, take all the billions in dollars and then go away. But actually seeing that dividends are being paid out, right? This is also very much, of course, in the interest of the shareholders. So, taking away a little bit of that stereotypical, argument against the Chinese ADR in general, I would say.
Yeah, 100%. I would agree, Marcel, that, it's something that, a lot of times people would say, these companies, what do they care? And, I would disagree with that, the majority of these companies, the founder is the CEO, the chairman or chairwoman, has significant capital in the same stock we own. And, we saw Alibaba very significant increase in their buyback program. We had Tencent spinning off their JD position. And now we're seeing JD itself paying a dividend. So I think, net, these are very shareholder friendly moves. And I think they're trying to make the securities a little more enticing to investors.
Yeah. So on the economic situation, what do you think would be a realistic timeline to kind of see the effects of some of this easing, even if it's maybe not as aggressive? But of course, we would need to have Shanghai come out of a lockdown, right? And then more in general, any other economic factors that you see? I think one important piece of the CSRC issue was also that they actually talked about the capital markets role and that they should be stable around the time of the party meeting, right? The November meeting, the important one.
Yeah. Certainly stability is always job one in China. And I think some of the talk with these big strategic investors in China is saying, hey, the Shanghai Shenzhen market's been off. We want things to stabilize, put some money to work, but certainly more so this year, just because of the People's Congress later on this fall. So I think we know, ultimately we know global stimulus is being retracted, and that will dampen the demand for the world's factory, which is China. And so China needs to make up for that slack, which we're going to see on the manufacturing side. And that becomes domestic consumption. What are the other levers they can pull? You don't want to go back and do the real estate. You want to disincentivize that. So it's got to be domestic consumption. And the number one issue with domestic consumption in China is the conservativeness of households due to the lockdown quarantine policy, which they've kind of reaffirmed. And if anything, that begs the question, why are Western vaccines not being used in China? And that's a little bit more difficult to say. We can, it's a combination of likely, reputation, saving face, pride, there's a whole host of issues. But I think what China really needs is a strong vaccine. And certainly it feels like we're getting closer, that, there's dozens of companies, pharma and biotech companies are working on this, in various stages. Some of those are clinical trials. And you can imagine, if we can get a good vaccine, an mRNA vaccine, I have no medical training, don't take my medical advice. But, if we get a strong vaccine, we know, that can be distributed very, very quickly. And what does that do? It's going to unleash travel, domestic consumption in a very significant way. And that's that, I think when you think about catalysts for China, a real HFCAA solution, that's a, coiled spring. But I think the vaccine, having a good vaccine, when that news, that's a real catalyst.
Yeah, good point. Because I was also thinking around, like, currently there's not much. You spoke about like how there's a lack of buyers, right? And there's not much reason to go into the sector right now. And it's kind of, we spoke about this the other day. It's kind of trading in this risk basket together with some of the profitless tech space, right? Which doesn't make really sense, because these companies have real earnings and cash flows that you could discount. And then I think that the question I'm also getting sometimes from viewers, and I think you also on Twitter, is like, when do we see this, discrepancy happening between those different areas and geographies?
Yeah, it's next week, Marcel, and you will make sure that you get in. But next week we're hosting a forum in San Francisco, and last night I spoke with one of our speakers. So Dan Nile is a little bit of a known investor here in the United States, mainly because he was Lehman Brothers tech analyst. And now he runs a hedge fund out of San Francisco, and he's going to do a little presentation for us in Q&A. And one of the things we talked about was this view of these companies, and there is you have, I think, a lot of growth investors. They own US growth companies, European growth companies, Asia. And so, yes, there's an element of, within tech, there is profitless growth. And those companies are long duration assets. Rising US interest rates is going to be highly problematic. But I would push back vehemently that the names, a lot of these China ADR names are far from profitless. And a lot of these companies from a traditional fundamental, analysis show that free cash flow yields and price to book and PE and what have you, that there's a big difference between these companies but some element of there is some overlap with some of the investors there. So hopefully, we want to see that differentiation take place, just because these companies are different. They that we're not seeing that. I mean, the other interesting, Dan Nile, being the tech analyst in the late 90s, and was he talks about what happened to NASDAQ, and his view was listen, NASDAQ, it was down 70-80%, which is kind of where we are. And so his view is, I don't want to put words in his mouth, but I think I would agree, that I think these names, they're at such a depressed value. You can't plant the flag and say, today's the low, but I just feel like there's been such a sell-off.
Yeah, maybe the last question that I have is regarding the very weak yuan and the strength of the dollar currently. What kind of, do you see any risk there, or what role does it also play in the ADR space?
Yeah. So I think in general, my view of what drives currencies is the difference of yields. If you look at the 10-year treasury in the US versus China, that historically it's been, the US was all the way down here and China was up here, and now we're like the US 10-year treasury is actually slightly higher. So it's funny, I saw something saying, China's devaluing their currency, and it's like, no, that's
manipulation.
Yeah, that's not what's happening at all. It's just investor capital flows to where they can take advantage. And certainly just this change between US government treasuries and Chinese government treasuries, that dynamic has changed. And that gets reflected in the currency. And people will say, no, countries are moving their, yes, countries can do things like what Japan is doing, where they're devaluing their currency in a significant fashion. But the way they're doing that is by not tightening, is by staying in this easing fashion. So this is more of a reaction of the US dollar being reflective in these stronger yields. It leads to more demand for the US treasuries, which means you have to buy the US dollar. And that makes Chinese 10 years treasuries less attractive. And that means that makes the renminbi less valuable. But I think where China is very conscious, where the State Administration of Foreign Exchange and the PBOC is a lot of politicians in the West will say, China manipulates its currency. They don't want to be labeled a currency manipulator. And so we're at this 650 level, which is a little bit of the level we had thought we could see an easing to. I think this is it's hard to know exactly what's safe in PBOC, but I think 650 is an area where they would defend the currency, that they don't want to see it deappreciate back up to $7, back to $7, because you'd see politicians calling them a currency manipulator. But this has more to do with the dollar, in my opinion.
On let's say on a positive side, doesn't that also open some room for more of discussions between the politicians of both countries in different fields? We heard about, I think there was a White House talk by Dees, right? One of the advisors, and about more exemptions from trade tariffs. So in a way of coping with inflation, but it kind of brings those countries back together and on a table and talking about to solving such issues, or, like how do we deal with this inflation issue? And maybe the Fed is even just bluffing, and we'll see also the yields coming down as well. So lots of dynamics in there, right?
Yeah, it's interesting. This was from the Deputy National Security Advisor, so kind of an interesting to see that message come from there. But we'll take it, and certainly, Janet Yellen has spoken about the effect of tariffs on inflation. That China does not write the check. Walmart does. U.S. consumers do. That when you import the goods, that importer pays the tariff check, and they then pass along that increase, that tariff to end consumers. So it has an inflationary effect. And I thought it was kind of an interesting to see. I thought that coming from the Deputy National Security Advisor is interesting. It's that this, it's just a little surprising there. But I think this is, again, a sign that there is some good news taking place, and it didn't get a lot of attention. The U.S. Secretary of Defense spoke with his Chinese counterpart. Part of me shakes my head. It's been 2 years, and this is the first time you picked up the phone. So and then I think I would say the CSRC. I understand some of the investor skepticism. But it is a good sign that they've said they're talking every week. It's clear the U.S. side is, what they want, what they need. Hopefully that's, China can allow that solution to happen. But there is some positives out there that, it's unfortunately not quite getting as much attention as we would like, but it's good to see that there is some dialogue taking place.
Right. So let's hope this whole drawdown was just engineered in order to get a good start for the Chinese private pension system. No, just kidding. But it's definitely rough out there, right? The last couple of days and weeks. But let's see how these issues will pan out next week. Let's hope for some buyers coming in. And as you mentioned, it's like a very attractive space in terms of valuations right now.
Yeah. I think it's, we kind of know a lot of this quote unquote big money, these big active funds, they want to see something tangible, right? They want to see something in writing. But at the same time, as investors, we might not have, we might not need that. And the market, hopefully will start anticipating some good news. And I think the JD dividend, if I was short, that dividend would make me a little more nervous, because what if Alibaba and others start doing the same, right? So hopefully we get some, hopefully next week's a better week than this week.
All right. Okay, so enjoy your weekend, Brendan, and then let's check in next time.